So my first topic today is basis, capital accounts, and record keeping. If you want to, I just showed you the cartoons. Okay. Okay, if you want to correlate it to the Ag Handbook, it's in pages 21 through 26 in the Ag Handbook, and also toward the end 111 and 112. This is updated for revenue ruling that came out last year that I'm going to talk about just in a few minutes, so it's current. So I wanted to start off talking a little bit about what basis is. So if I bought, for example, this piece of fine crystal for $100, okay, and then sold it for $110, how much of the $110 am I going to owe tax on? The whole amount? Just the $10 difference between what I bought it for and what I sold it for, right? Okay, so the first $100 of the $110 is getting back my investment in the crystal, right? Okay, so that's the, I want to say basically the idea basis, but it is the idea basis. So that if a definition then would be my capital or your capital investment in income producing property. And the law usually requires that basis be capitalized, and that means how many graduate foresters do I have? Okay, you go to valuation and your instructor talks about capitalizing an expense, and he means carrying something forward or backwards in time at a rate of interest. Okay, when an accountant talks about capitalizing something, that just means to hold it in a capital account at its original value without any adjustments for inflation. Okay, so law usually requires that basis be capitalized, which means in this case held in a capital account until the property is sold or disposed of. Now what happens with inflation over time is that the value then of that original amount that you put in the capital account erodes with inflation. So that what was worth $1 5 years ago might only be worth 80 cents now. Okay, so think in terms of a forestry linked investment over 40 years or something like that. You know, you might end up with those dollars being worth less than half of what they were when you made them, when you made the original investment. Okay, so, to help us understand what basis is, so we'll talk about some things that basis is not, and that's things like operating expenses and carrying charges. So this includes what are operating expenses and carrying charges is things like property taxes, consulting fees, labor costs, travel expenses to and from meetings like this one that have to do with your forestry enterprise. Interest also that's related to the income potential of the tract, the costs of pre-commercial thinnings, prescribed burnings, timber stand improvement, the costs of protecting your forest from fire or diseases, and also this is Revenue Ruling 2004-62, the cost of post-establishment fertilization is an operating expense, or well, is an operating expense. Okay, the cost of fertilization that that's involved with the establishment is a capital expense. So as long as you're engaging in profit for timber growing for profit, these operating expenses and carrying charges can be deducted in the year that they occur. Okay, you don't have to capitalize them. You can if you choose to, but it's generally better to go ahead and deduct them. And timber qualifies as something that you're engaging in for profit as long as it produces income or appreciates in value in at least 3 out of 5 years. Now you might not meet the first part of this definition, and this is a part that your tax professional is going to be familiar with. The producing income in 3 out of 5 years. But timber qualifies if it appreciates in value, and it's hard to keep it from appreciating in value, right, as it sits out on the stump and grows. Okay, so it will meet the requirement for a property you're engaged in for profit as long as it's sitting out there in the woods appreciating in value. Oh, and where this occurs in the Ag Handbook is on page 39. You can look in there, and it says it in black and white. So you can, if your tax professional says that's not right, you can open up the book and show them it's there in black and white. Another type of thing that basis is not is the cost that's associated with the sale of timber or forest land. So this would be, for example, the cost of a cruise that's done to determine the volume of timber that you're selling, the cost of advertising and administering the sale. All right, these are also capital expenses, but what you do is you deduct them directly from the sale proceeds. Okay, now your original basis, we know what basis is in general now, and so we start off the first value we put in our basis account, or in your basis account, is the original basis, and that depends on how you acquired the property. If it's by purchase, it's your total cost of acquisition, so it's not only the sale price, it's any other cost of acquisition involved in that purchase. All right, not just the purchase price, and not its fair market value. All right. If you acquired it by inheritance, it's the property's fair market value on the date the decedent died, or the alternate valuation date, which is the earlier of 6 months after the death, or the date that any estate asset is sold. So you can see that's probably going to be a higher, since it's the fair market value on the date the decedent died, that's probably going to be higher than the basis in the decedent's hands. Okay, so you get a higher value to start off with than they had. So that's what's called a step up in basis. If you acquire the property by gift, you don't get the step up in value. It's the lower of the donor's basis or the property's fair market value. So it'll be probably the donor's basis it was in their hands. For gifts made after 1976, which would be most gifts now, you add the portion of any gift tax paid due to the difference between the donor's basis and the property's fair market value. For gifts that were made before that time, add any gift tax that was paid. Ideally, you determine your original basis immediately after you acquire your timber or forest land. If you postpone the process for several years, you're going to need the help of a forester to help you determine the tree's original volume and original value. They'll go out and take increment cores and determine what the original volume of the timber was at the dates years ago that you acquired it, and then look up in their records and see what the value of that was. And the reason you're going to need a professional help from a professional is that you may need to justify that number then to the IRS, okay, to this guy. You can read his T-shirt, "I love auditing," even if today is, if it is Dress Down Friday that you see him. You're going to need to be able to justify your number, so you want to make sure you have a qualified person. And then what you do with your original basis is you allocate it proportionally among your capital accounts. For example, two accounts that everybody's going to have is a land account and a timber account. You might also have other types of accounts that we're going to talk about later. Now, after you make one or more adjustments to your original basis, you don't have original basis anymore, you have adjusted basis. And the types of adjustments you would make would be to adjust it up by the amount of new purchases or investments, and down as you recover your investment. Okay, so then you don't have original basis anymore; you have adjusted basis. So the definition for adjusted basis would be the balance left in a capital account after one or more changes have been made to the original basis. So how do you go about recovering your basis? There's different ways for different types of assets. In some cases, you take deductions when the property is partially or completely sold. In other cases, you take depletion deductions as the property is used up, or you might take depreciation deductions over the property's useful life, or you can amortize, in some instances, capitalized expenses. Now, amortize is just an accounting term that means to write it off over a determined a number of years. Okay, the different types of capital accounts you might have is everybody, again, is going to have a land account. Everybody's going to have a timber account. You might also have a depreciable improvement account, an equipment account, and a building account. So I'm going to go over these one at a time and talk about what goes into that type of account and how you go about recovering your basis. So the first one was your land account. What goes in is the portion of your original basis that's attributable to the value of the land itself. You add to that the original basis of any new purchases, also the cost of any non-depreciable improvements you do to the land. For example, the roadbed of a permanent road that you might put in, that's a permanent improvement. Also, if you do any land leveling, we're talking more about, I guess, rice here than trees, but that's another example of a non-depreciable improvement. And according to the IRS, the cost of defending your title to the land needs to be added to your basis in the land account. So if you have an encroachment, if a neighbor puts a fence on your land and you have to take them to court and defend your line, that goes into your land account, the cost of that. How you recover your basis in the land account is the only way to recover your basis is to sell or dispose of the land. So as long as you have, as you own the land, you're going to have that, the amount that you allocate to that capital account is just going to be in there. Okay, the next type of account that everybody's going to have is a timber account. And timber account's a little bit unusual in that you need to keep separate sub-accounts for merchantable timber and young growth. This would be naturally seeded trees of pre-merchantable size, and also plantations, which is artificially planted or seeded trees of pre-merchantable size. So you might have 3 separate sub-accounts within your timber account. Further divisions, for example, if you keep track of your records by tract, even by stand or species, that's fine if it helps you manage. The only thing is it makes filling out the tax forms a little bit more complicated. And in the event of an involuntary conversion, that's my last talk today, it may prevent you from getting the largest possible deduction if you do it that way. But if it does help you manage, go ahead and do it, because we're not really anticipating an involuntary conversion. What goes in to your timber account? Another unusual thing about timber accounts is that it has 2 different types of basis. There's a value or a cost part, which is the portion of your original basis that's attributable to the value of the timber, whether it's merchantable or pre-merchantable when you acquired it, and also a volume part, which is the timber volume at the time of acquisition. If it's merchantable timber, you keep track of it in standard units, 1,000 board feet, cords, cunits, however you keep track of your timber. If it's pre-merchantable, there's no volume there to record cords or 1,000 board feet, so you keep track of that in terms of acres. Okay, now you increase your timber basis by the value and the volume of any new purchases of forest land or timber that you make. Also the cost of timber establishment. So this includes things like site preparation, including practices that you do to encourage natural regeneration, if that's the form of regeneration that you use. Also the cost of planting or seeding trees, and this includes the cost of hired labor and a forester's fee or salary that represents time you spent overseeing the planting or seeding. Also the cost of replanting or reseeding after mortality. Okay, the IRS holds that the cost of timber establishment includes in a plantation the cost of brush and weed control that's essential to the survival of the plantation. And the test comes from Revenue Ruling 6618. Now the first numbers in a revenue ruling are the year that it came out. So this is an old revenue ruling. But the test is whether it's done in the first 2 years after planting. So non-essential control, it doesn't have to be capitalized, it can be expensed. So if you have an option, I want to talk about tension in tax laws a little bit. If you have an option of doing brush and weed control within the first 2 years or right after the first 2 years in the 3rd or 4th year, when would you prefer to do it from a tax standpoint? Would you prefer to do it in those first 2 years or after the first 2 years? There isn't any difference between expensing it and deducting it. That's the same thing. But if you do it in the first 2 years, you can't expense it or deduct it. You have to capitalize it. Okay, so would you prefer to capitalize it or expense it? Usually you'd prefer to expense it, okay? If you capitalize it, you just put it in that capital account and it sits there until you sell timber or write it off some other way. Okay, so as it's sitting in there, remember, inflation is eating away at its value. Okay, so it's generally better to expense something. So if you have a choice and you can afford to wait to do this brush and weed control, you'd prefer to wait until after the first 2 years. Okay? Now in a natural stand, we have a different revenue ruling that applies to natural stands. Weed and hardwood control done that's essential to the survival of that natural stand has to be capitalized. Okay, and this test comes from Revenue Ruling 76290. If it's done to ensure the survival of that stand. If it's done to increase the vigor and speed the growth of that stand, you can expense it. So what's the reason you're going to do brush and weed control or weed and hardwood control in a natural stand? Would you rather expense it or capitalize it? Okay, so you're going to say that it was done to increase the vigor and speed the growth, right? Not to ensure its survival. That's a tax tip. Okay, as your timber grows, you want to transfer the value and the volume basis in your young growth or plantation subaccount into your merchantable timber subaccount. As it becomes merchantable, you also update the volume basis in your merchantable timber subaccount for growth and ingrowth. Also, if your utilization standards improve, or if you change your unit of measure, if you go from 1,000 board feet, for example, to tons. You update how often you do it. Annually, if your tract is large and you have frequent transactions, at the minimum, you need to update your timber account in years that you sell or dispose of timber, because you need current numbers at those times in order to calculate your depletion deduction. Okay, how you recover your basis in your timber account is, first of all, you can take a depletion deduction when you sell or convert timber. You cannot take a depletion deduction for trees that you cut for personal use, for example, for firewood or barn poles, though. Also, you can well, that's not going to be the case after this year. Up to the middle of October of last year, you can amortize reforestation expenses. Now, the timber depletion deduction is it's just a two-step process. First of all, you determine your depletion unit, so it's your adjusted basis divided by the volume of timber that's out there on your whole tract or in your whole depletion account at the time immediately before the harvest. And then, so that's your depletion unit. That's your investment per unit of timber, right? Okay, and then you multiply that times the number of units that are actually harvested. So that'll be your depletion deduction. Okay, the next type of account you might have is your depreciable improvement account. So what goes in is the portion of your original basis that's attributable to the value of depreciable improvements to the land. So examples of those would be things like bridges, culverts, fences, temporary roads, or the surface of a permanent road. So you can depreciate the surface of a permanent road, but not the road bed itself. Also, any new investments in things of this type. You recover your basis by depreciation deductions, and Larry's going to talk about how to do that later today. Another type of account that you might have is an equipment account. What goes in is you need basically a separate sub-account with the portion of the original basis that's attributable to each piece of equipment with a life expectancy of over 1 year. So examples of this are things like chainsaws, trucks, planting machines, okay? Now, in some people's hands, a chainsaw might not have a life expectancy of over 1 year, okay? But the IRS says that you have to depreciate a chainsaw over 3 years. Also, the amount of any new purchases, you basically need to establish a new sub-account, a separate sub-account for them. You recover your basis again by depreciation deductions that Larry's talking about later today. Another type of account you might have is a building account. What goes in is, again, separate sub-account with a portion of the original basis that's attributable to each structure that's on the property. You add or generate a new sub-account for any new structures, and you recover your basis through depreciation deductions. All right, allocating your basis, you must allocate all your costs of acquisition proportionally among the different capital accounts you're going to have. You don't put it all into one account, especially you don't put it all into your timber account, and you don't deduct it as an expense, although I know people that have done both things. Now you know not to do that, okay? You report your original basis on Form T Part 1 that we're going to see in a few minutes. You report reforestation on Form T Part 4 that you'll see later today. And you report any adjustments to your timber basis on Form T Part 2 that you're going to see a bunch of times today. All right, so let's work through an example. Let's say that 6 years ago you bought 40 acres of forest land for $50,000. A cruise you had done to help determine how much to offer showed that the tract had 2 20-acre loblolly pine plantations. So this is an investment you made down south. One had 72,000 board feet of saw timber worth $19,800 and 560 cords of pulpwood worth $14,000. The other stand was pre-merchantable, but you assigned a value to it of $300 per acre. The fair market value of the land itself, just the bare land, was $14,000. In addition, you paid $800 for a boundary survey, $300 for a title search, and $800 for the cruise itself. Allocate your original basis then among your capital accounts and report it on Form T Part 1. So which of these numbers here is going to be a cost of acquisition? I'll do the easy one. The $50,000 is a cost of acquisition, right? Okay, what else is a cost of acquisition? The survey is one, the title search is one, and the cruise is one. Okay, those are all costs of acquisition. What are these other numbers up here? The $19,800, the $14,000, the $300 per acre. What are those? Those are fair market values, right? So your total acquisition is what we talked about, the $50,000 that you paid the seller, plus these other costs, the survey, the legal expenses, and the cruise. Okay, so your total cost of acquisition then for this $50,000 asset was $51,900, okay? And if you add the fair market values together, so this is, I don't remember which is which. This is probably the land, the saw timber, the pulpwood, and the pre-merchantable timber. It comes out to $53,800. So you bought an asset worth $53,800 for $51,900. You felt like you made a pretty good deal, right? Okay, you paid less for it than you thought it was worth. But the cost of acquisition and fair market values aren't equal, so you need to allocate your original basis proportionately among your capital accounts. And how you do that is this way. First of all, you take the fair market value of each part of the asset. So $14,000 of it was for the land, $19,800 was for the saw timber, another $14,000 was for the pulpwood, and the $6,000 was for the plantation. So I got it wrong when I was guessing. But this is what adds up to the $53,800, okay? And then you calculate the proportion, the percentage that each represents of the whole. So $14,000 is 26.02% of the total, okay? And $19,800 is 36.8% of the total. And $6,000 is 11.16% of the total, okay? So then you take these proportions and multiply them times your total cost of acquisition. So 26.02% of your total cost of acquisition is $13,504, and that's how much you're going to put in your land account, okay? That's your original basis in your land account. 36.8% of $51,900 is $19,100, so that's the original basis in your saw timber sub-account, okay? 26.02% again of the $51,900 is $13,504, so that's going to go into the pulpwood sub-account. And 11.16% of the total original basis, total cost of acquisition, is $5,792, so that's what goes in your plantation sub-account, okay? Okay, so I want to show you what the forms look like. This is, I used to require that the students fill these forms out, but I gave that up after 12 years, okay? I'm giving you filled out forms, so you can watch. You don't have to write furiously. Okay, so you put your name in that blank timber account. It's your timber account. Here's my favorite part of the form. The legal description of that tract goes here in this squinchy little line. Okay, so it's going to overflow onto what we call a Form 3P, right? A plain piece of paper. And then the name and address of the person that you bought it from goes on line 3A, and on line 3B is the date of acquisition, month, day, and year. Okay. On line 4 is the amount that you paid to the owner. Okay, in cash or interest-bearing or non-interest-bearing notes or other consideration if you get into that. But we didn't. It was just $50,000 in cash in this example. And then these other costs of acquisition. Here's your legal expenses on line 6. And then crews and survey are both specifically mentioned on line 7. Those are the two $800 expenses. So here on line 8 is your total cost of acquisition, the $51,900 that we already knew, right, from the worksheet that we did. But this is how we show the IRS. Okay? And then we take that value on line 8. We take this $51,900 cost of acquisition on line 8, and then we break it into the separate sub-accounts on all the different parts of line 9. Okay, so remember we had $13,504 that we wanted to allocate to the land account, and you know there's 40 acres of land out there, so if you do the division you find out you have $337.60 invested in each acre of the land, okay, and that's just the land itself, not counting the trees. We had $13,504 that we wanted to allocate to the pulpwood sub-account, right? And you know from the forester's crews that there was 560 cords of pulpwood out there. So your investment per cord is $24.11, okay? We had $19,100 that you wanted to allocate to the merchantable saw timber sub-account. You know that there were 72,000 board feet out there. So you have $265.28 invested in each 1,000 board feet, okay? And then for the pre-merchantable timber here on line 9E, you had $5,792 you wanted to allocate to it. You know that there were 20 acres of pre-merchantable timber, so you had $289.60 invested in each acre, okay? Now these numbers here, all the different parts of line 9, they add up to $51,900. Okay, now this number on line 9H needs to equal this number up here on line 8, because it's the same thing, just divided up among the sub-accounts. Okay, so if this number doesn't equal this number, you know you've made an arithmetic error somewhere. Let's continue the example, okay, and say that by the end of this past year, end of 2004 then, the younger plantation has become merchantable and carries 200 cords of pulpwood. The older plantation also has grown and now carries 112,000 board feet of saw timber and 390 cords of pulpwood. So some of that pulpwood's grown into saw timber. So adjust the basis in your plantation and merchantable saw timber sub-accounts and report those changes using Form T Part 2. Okay, so what we're going to do is we're going to take the plantation sub-account and basically we're going to empty it out into the merchantable timber sub-account. Okay, so we're going to subtract out the value basis, the $5,792 we had allocated to the basis of that plantation, and we're going to subtract out the 20 acres of volume basis. So we're going to wind up with zero then, zero value basis and zero volume basis in the plantation sub-account. Okay, so let's look on the next sheet in your forms handout, and I'll show you doing that. Okay, so here's Form T Part 2. On line 10 is the name of the sub-account, the plantation sub-account, and what you're doing to it. I put that in parentheses just to make it clear that you're emptying out that sub-account. So line 11, the estimated quantity of timber and value or cost basis that's in that account is the 20 acres and $5,792 that we started with. All right. There's nothing on line 12. On line 13A, addition for growth over 5 years, so the 5 is there. And line 13B is transfers from, and here I'm interpreting from as out of. So we're transferring out 20 acres, all 20 acres, and we're transferring out all $5,792 of cost basis or value basis. So on line 16, total at the end of the tax year is going to be 0 acres and $0. Okay, there's no other adjustments. So on line 25, the net quantity and value at the end of the tax year, again, is 0 acres and $0. Okay, so we're just emptying this sub-account out. Okay, then the next thing we're doing is in that merchantable saw timber, in the merchantable timber sub-account, we're going to add the value basis from the plantation sub-account. So we had the pulpwood and the saw timber bases added together was $32,604. We're going to add to that $5,792 of basis that we're transferring out of the plantation sub-account. So we're going to wind up with $38,396 in the merchantable timber sub-account. Also, we're going to update the pulpwood volume basis. We had 560 cords originally. We're adding to that the 200 cords that we're transferring from the plantation sub-account. We're subtracting out 170 cords that grew out of pulpwood into saw timber. All right, so we're going to have 590 cords total adjusted volume basis. We're also updating the saw timber volume basis. Here we go. We started off with 72,000 board feet originally. We had 40,000 board feet that grew out of pulpwood into saw timber. So we have a new volume basis in the saw timber of 112,000 board feet. Okay? So that's the two volume ones. And we show that here on the next page. Should be another Form T Part 2. Okay? I put Doyle up here above any lines. You want to put the log measure. Since this is a southern example, I put Doyle. Out here you would put Scrivener decimal C. Okay, on line 10, what we're talking about here is the merchantable saw timber sub-account, and what we're doing in parentheses is to transfer out the volume and cost basis from the plantation sub-account, plus we're updating or adjusting the merchantable saw timber sub-account for growth and for ingrowth. So we started off with 560 cords and 72,000 board feet originally. That's what we had 5 years ago. And we had $32,604 at cost basis or value basis assigned to the merchantable saw timber sub-account. Over this 5 years, we had 170 cords of pulpwood that grew into saw timber, so we're subtracting out the pulpwood and adding the saw timber. We'll put the 5 here in the blank on line 13A. Also on line 13B, we have transfers from the pre-merchantable. That was the source of these transfers. Timber account of 200 cords and $5,792 of cost basis or value basis. Okay, no other adjustments. All right, so 590 cords, 112,000 board feet, and $38,396 in the column B of cost basis or value basis. All right, some words about record keeping is you need to keep accurate and complete documentation in order to support all the entries that you make on a tax form. Remember the guy, the auditor there, word is I love auditing. So you need to be able to justify your numbers that you put down on the tax forms to him. So this includes things like having a written management plan. How many of our forest owners have a written management plan?
Not very many.
All right, right after this, right? Tomorrow. And as long as you have a written plan, put in there that one of your objectives is timber growing for profit. So you have that objective right in there in black and white. Okay, maps, copies of contracts and invoices for any operations that's done on the track. Receipts, canceled checks, mileage records, for example, to this workshop here today. This is my Yule Brenner imitation here, etc., etc., etc. Okay, anything that you can use to support a number that you put on a tax form. Now these mileage records, they can be in a little pocket calendar. Write down 100 miles up here and 100 miles back tomorrow. Just write on the pocket calendar on the day that you did the driving. Okay. And we get asked also, how long do you need to keep a copy? Do you need to keep tax forms? You want to keep a copy of every tax return that you file indefinitely, which means as long as you live, okay? Because there is no statute of limitations for failure to file, okay? So you want to keep a copy of every return that you file as long as you live, but you only need to keep the records to support those the current deductions on those returns for 6 years beyond the date that return was due. So after 6 years, you pull out the tax return and file it, and then all that supporting documentation goes through the shredder. Okay? You want to keep records that support capital accounts, though, for 6 years beyond the period of ownership. So if this is something you hold your whole life, timberlands you own your whole life, you want to keep those records as long as you live. Don't run them through the shredder. Okay? That would be an irreparable mistake. A few words about record-keeping methods. There's basically 3 ways. The simplest is what we call the Shoebox Method, which means routinely and systematically filing records in folders, envelopes, or shoeboxes even that's labeled for each necessary tax category. Okay, this is a perfectly adequate method for family forests. It's put a lot of kids through college. They get their business degrees and come back and they're horrified that their parents are using the shoebox method. They want them in double entry bookkeeping, but it's perfectly adequate. Okay. The next higher level of sophistication would be a tree farm journal, which is basically a business diary that shows the details of your transactions and the time that you spend doing activities. This is going to become important later today. It makes it more convenient if you sort your entries by category rather than chronologically. And then the next higher level of sophistication would be a tree farm journal with accounts. So this has the business diary part of it, but the dollar amounts are posted to ledgers. So you might use the most sophisticated way to keep ledgers, then would be double entry bookkeeping with debits and credits. Okay? Accounting methods, you can adopt the accounting method that provides the most favorable tax treatment to you as long as it clearly reflects your income. This is the legal requirement, that you're not using a way that allows you to hide income. Okay, there's basically 2 approaches. The cash approach, which allows you to deduct your expenses when you pay them and report your income when you actually receive it or constructively receive it. This is the method that's used by most farm and forest owners. A more theoretically correct way might be the accrual method. This means you deduct your expenses when you incur them, not when you pay them, and you report your income when you earn it, not necessarily when you receive it. You remember your timbers are gaining value as it sits on the stump, right? So if you use the accrual method, you earned income as the timber is growing, right? But unless you have a timber sale, there's no dollars in hand to pay taxes on it. So the only type of people that use this is large firms and incorporated tree farms that have transactions every year, so they have money in hand to pay the taxes that's due on the growth of their timber. Okay, any questions on this part?